The trend line in the gold market has accelerated since the 2015 bottom, and we keep going higher, faster. It might not feel like it during little pullbacks like this one, but that is the situation. Well, hello there, my friends. Rafi here from the End Game Investor with this week's silver report for Arcadia Economics. People seem to be worried about my situation here. Everything is fine. There were a few bombs yesterday and fires all around the city, but I figure if everything, all the shrubbery around the city gets burned, then there's no chance of a fire getting into the city. So everything is for the best, I guess. So far, nothing this morning, so that's good. Everything smells like smoke, but could be just a big barbecue. A lot to talk about today. The first thing is that gold open interest appears to be resetting downward, which means bullion banks are closing their short positions. They're still at near a record high in short positions, so that does have to clear, though that's on a 10-day lag, so we don't know exactly what the numbers are yet. The last major low in gold happened at 400,000 contracts, and we are down about 100,000 from the top of 540,000. Closing of 100,000 contracts in about 3 weeks and only a $100 effect on the price of gold. That's pretty good news, and it shows that gold has been pretty resilient as open interest has reset lower. Where is the wall of the next financial crisis? Well, we don't know exactly, but I can show you the last repocalypse in 2019 happened when overnight repos took up about 85% of available bank reserves. We are now at about 57%. We've been climbing since 2022 when we hit a low of 20%. So we could get to 85% within the next few months, depending on how fast reserves drain and how fast overnight repos continue to grow. And they're at about $2 trillion a night, with bank reserves at about 3.4 trillion. Chinese premiums, I'm going to go into that once more. And notice a difference between Chinese premiums when they spiked in the past and when they're spiking now. They have been consistently high, and they are at about 13% now. They've been that way for the last few months. And this is an exception now because in the past, high Chinese premiums correlated with lows in silver, and now they just keep climbing with the silver price. I'm going to go into the long-term view of open interest in silver. It is not the same as open interest in gold and does not appear to correlate with price anymore, though in the 1970s and 1980s it absolutely did, but there wasn't much move in open interest in silver during the 2011 top. I wanted to take a long-term look in gold, or at least a medium-term look in gold since the 2015 bear market bottom. This hasn't been pointed out by anyone that I've seen, but the uptrend lines, the intermediate trend lines in gold, keep moving up in slope every time we hit a major bottom. This is the fourth one by my count since 2016. You can call them yearly cycles, intermediate cycles. If you're a cycle theorist, you probably have more exact terms for it, but I'll show you the chart in the final slide of this presentation, and you'll see what I mean. Before we get to any of that, this week's Silver Report is sponsored by Fortuna Silver Mines, symbol FSM. Just wanted to quickly go into one slide of their featured presentation. We can see here that gold revenues, sales, account for 81% of net sales of $225 million, which is up 28% since the same period in 2023. Good growth going on here. What I wanted to point out is that silver only accounts for 10%, and though you could say that they are essentially a gold miner now, however, when we get a lower gold to silver ratio, we're now at 80, which is still pretty historically high. As we descend towards 15-1, which is my end game gold to silver ratio, we won't be there for very long, but we should get consistently lower in the gold and silver ratio as we approach the end game. And as we get there, silver revenues will increase relative to gold revenues, and we should be about even or close to even as the gold and silver ratio descends to 15-1. So don't take silver out of Fortuna Silver Mines quite yet. And with that quick note from our sponsor, let's continue with this week's Silver Report, brought to you by FSM. There was some big news this week about the CPI, the Consumer Price Index inflation rate, which is pretty fluffy and not very reliable, but it does say something. We should keep in mind that according to this Atlanta Fed sticky price inflation CPI, which calculates prices that do not change very often, we are still at highs from 1991, 33 years. So it's a 33-year high in sticky price inflation, 4.3%. Yes, we have descended from all-time, not all-time highs, but since 1978, I think, or something like that. So yeah, we've descended here, but we're still at highs not seen in a third of a century. So put things in perspective. And now to gold open interest resetting here. I want to show you one of my patented rectangular charts showing correlations in gold futures between open interest and the price. So in this box, we see here that the gold price has descended from about 24.50, from a high of 24.50 to 2,300. You say $150 from 24.50. So that's about 5-6%, something like that. Not much of a move in gold for a move of 100,000 contracts down in open interest. We are at 436,000, 437,000, maybe a little bit lower today. As you watch this, gold did fall a little bit yesterday, which probably means open interest fell further. I would like to see us get back down to 400,000, which cemented a pretty strong bottom back in late February, from which we decided to rocket from about 2,000 to 24.50. We could see that again if we descend to 400,000 open interest contracts here, and we're pretty close. So just to show you what happened last time, we fell about 100,000 contracts. We fell here from 500,000 at the beginning of 2024 as the year turned to the end of February. So that took about 2 months. That's it. Fall of 100,000 contracts, and it was only a fall of $100, 4.7%. So after that, we saw a big move, and we're seeing something similar, about $150. It's around the same percentage, and the same 100,000 contract fall. If we can get down to 400,000, that would be about 140,000 contract fall, and then we should be around a pretty firm bottom. This is a chart that I shared on the Endgame Investor, which you can subscribe to for free on Substack, endgameinvestor.substack.com. And this shows the amount of bank reserves being taken up by repos. Bank reserves is the high-powered money that is at the bank account of the banks at the Fed. And there's a total of about $3.4 trillion available now. We can see here why the repocalypse happened. Going into the repocalypse of 2019, the repo markets were getting more and more flooded, more and more crowded, as more and more hedge funds were accessing the repo market to fund their treasury shorts, which is the same thing that's happening now. There's record amounts of short positions in 5-year treasury notes specifically. I don't know why that security, but I do know that the spread between futures and spot in the 5-year treasury notes, futures, and the bonds is about 76 cents last time I checked. And so that's free money that you can get by selling futures short and buying the bonds themselves. So that's why there's so much short positions in 5-year futures, and those futures positions are being funded by the repo markets. So the same thing's happening now as happened back then. We're not at the extremes because we have higher levels of reserves. But the point is, here at the high here, which caused the apocalypse, 85% of bank reserves were being taken up by the repo market. We're now at 57%. We've been trending higher since 2022. And when we get near 85%, that should be the next apocalypse, where the Fed has to print repos, print money to fund the repo markets, and then print a whole bunch of money besides. The higher we go, the closer we get to that wall, is the general point. Bullion bank shorts near records. So we just did open interest in gold, and this number could be different now. It's on a 10-day lag or something like that, maybe 2 weeks, something between 10 and 14 days. So we do see here that bullion bank shorts are at 226,000, and they've only been higher than that once in 2022. I think this is the March 7th, 2022, our nickel Armageddon, where the entire commodities futures markets across the globe almost crashed when there was a big short squeeze in nickel. But we do see here historically that when we are at these levels in bullion bank shorts, we are typically at highs or local highs in the gold market. It doesn't happen every time, but it did happen these 3 other times. So let's say 75% of the time to reach these levels. So it happened in 2016 at the 2016 high after the end of the bear market. It happened here in mid-2020 leading up to the August 2020 high. And it happened here in 2022 around the nickel short squeeze. So chances are we still need to descend a little bit more in the gold market. Doesn't mean we have to break this uptrend line, but we could get a little bit lower. And then we'll be at a firm bottom once we hit 400,000 contracts in open interest and these short positions get covered. Chinese premiums. I've showed this chart before. I want to make it a little bit more concise this time. So I rectangled the 3 previous times when Chinese premiums for silver were at these levels, these consistently high levels of about 13%. So there were 3 times, right? Once in 2011 following the silver top. And that here, if you follow the rectangle, is at this low after the second major sell-off after the $50 top. So meaning this premium came at a local silver low. This premium also came at a local silver low at the end of 2014. And so did this one at the 2020 sell-off when silver hit about $11.50 during the COVID lockdown panic. This is different though, because these premiums are rising even as the silver price continues to rise. So this has never happened before. And it means that there is sustained demand in China. Doesn't mean there's not going to be pullbacks. We just saw one a few days ago. But the Chinese are stacking silver. Exactly why? I suspect it has to do with their falling real estate market, and Chinese need places to put money that isn't in real estate, and they're going back to their tradition of stacking gold and silver, because even in China, it was money and still is. A long-term look at silver open interest. So we have here, we see different stages in this market. In the 1970s, it was very obviously clear that the silver derivatives market, that the silver futures market was being used to manipulate the silver price down. You can see here that open interest climbed to all-time record highs that haven't even been close to being replicated since then. So we have here in the 1970s, this is after the 1974 parabolic top here at about 650, I think it was. And then silver didn't do anything until 1979 about for 4 years. So why didn't it do anything for 4 years? Because, well, everything was being done in the futures market, and that was clearly being done to suppress the silver price, stacking huge amounts of paper silver over the available silver supply. And that ended in 1979, 1980 as these positions were being closed, and silver went into a parabolic top that has still not been replicated since. This is the end of manipulation, right? At least as per the futures market affecting the silver price. And we see here that since then, in 2011, when silver hit $50 again, there wasn't much activity in the paper futures market. There wasn't much activity in open interest here. It wasn't being done there. I think this was mostly an ETF-driven rally. It was an SLV mostly, and it could be that retail traders were just chasing it. But we see here that we have an inverse correlation as open interest gets higher. From 2011 until 2020, the silver price trended lower. So that was sort of like this, but not as much. And now we're seeing a local higher in open interest and a push to silver beyond 30 here. But my point is here that silver open interest is not very much correlated to the silver price. I wouldn't worry that much in terms of long-term trends about silver open interest being high here. No, it probably does need to set down a little bit. I'm going to be following gold open interest, and silver should follow that as it naturally does. The final chart I wanted to show you here is the trending higher in the slope of the trend lines in the gold market since the 2015 bottom. So if you draw a trend line from the 2015 bottom over here, late 2015 at around 1054, and then we had a trend line hit in 2018 at about 1250 something. We're way beyond that trend line now if you extend it out to the present. Then we established a new one at that bottom, which was tagged in 2020, late 2022 at 1610. Right, so that trend line we're now at a new one with an even higher slope from the 1610 bottom until the September, October 2023 bottom. That's also happened to be when silver hit $16. So that was about 1810, 1820, if I remember correctly, in gold. And now we have a new trend line established from then, which was hit in early 2024. And now we are way beyond that trend line. And notice also that these trend lines keep getting shorter and shorter by the time the trend line slope increases. So the rate of acceleration of the gold price has accelerated. That's what acceleration is. The trend line in the gold market has accelerated since the 2015 bottom, and we keep going higher, faster. It might not feel like it during little pullbacks like this one, but that is the situation. And so, my friends, we're at another briefly frustrating period in gold and silver. It shouldn't last much longer. Open interest has reset and continues to do so. I'm hoping we get down to 400,000 contracts before we hit another firm bottom. And then we should head higher again. Meanwhile, we keep getting closer to that wall that will precipitate the next financial crisis. Don't know exactly where it is, but I maintain and I hold my position that we are in for one final financial crisis, after which there will be another printing round of several $1 trillion, 5 to 10 trillion, something like that. And then we should head directly to the end game within months after that final financial crisis. This is Rafi with the Endgame Investor with this week's silver report for Arcadia Economics, and I'll see you guys next week.